This is Finance Spotlight brought to you by ThinkSpace Media. Investment decisions are often perceived as purely rational endeavors based on data and analysis. However, the reality is far more complex. Human psychology plays a significant role in how investors make decisions, often leading to biases and irrational behaviors. Understanding the psychological factors that influence investment decisions can help investors recognize and mitigate these biases, ultimately leading to more informed and effective decision-making. In this video, we will unveil the psychology behind investment decisions, exploring key concepts, common biases, and strategies to improve decision-making processes. And don't forget to subscribe, like, and share your thoughts in the comments sections. The role of emotions in investment decisions. Emotions significantly influence investment decisions. Fear and greed are two primary emotions that drive market behavior. Fear can lead to panic selling during market downturns, while greed can result in irrational exuberance and excessive risk-taking during bull markets. Understanding the impact of these emotions is crucial for maintaining a balanced and rational approach to investing. Fear and panic selling. Fear can cause investors to sell their investments at the worst possible times, typically during market downturns. This panic selling is often driven by a desire to avoid further losses, but it can lead to realizing significant losses instead of waiting for the market to recover. The emotional response to market declines can be exacerbated by media reports and the behavior of other investors, creating a feedback loop that amplifies the sense of panic. Greed and irrational exuberance. On the other hand, greed can lead investors to take on excessive risks in pursuit of higher returns. This often manifests during bull markets, when rising prices create a sense of euphoria and a fear of missing out, FOMO. Investors may chase after high-flying stocks or speculative investments without adequately assessing the risks involved. The result can be overvalued assets and eventual market corrections. Cognitive biases in investment decisions. Cognitive biases are systematic patterns of deviation from rationality and judgment. These biases can significantly impact investment decisions, often leading to suboptimal outcomes. Here are some common cognitive biases that affect investors. Overconfidence bias occurs when investors overestimate their knowledge, skills, and ability to predict market movements. This bias can lead to excessive trading, underestimating risks, and overallocating to individual investments. Overconfident investors may also ignore contradictory information and fail to diversify their portfolios adequately. Confirmation bias is the tendency to search for, interpret, and remember information that confirms one's preconceptions while ignoring or discounting information that contradicts them. In investing, this can lead to reinforcing existing beliefs about an investment's potential, even in the face of evidence to the contrary. This bias can result in holding on to losing investments for too long or missing out on new opportunities. Anchoring bias occurs when investors rely too heavily on the first piece of information they encounter, the anchor, when making decisions. This can lead to underestimating the impact of new information and making decisions based on outdated or irrelevant data. For example, an investor might cling to an initial purchase price of a stock as a reference point, affecting their judgment about whether to buy or sell as the stock's price fluctuates. Herding behavior is the tendency to follow the actions of a larger group, often driven by the belief that the collective wisdom of the group is superior to individual judgment. In financial markets, herding can lead to bubbles and crashes as investors collectively drive prices up or down based on the behavior of others, rather than fundamental analysis. Herding behavior can also result in missed opportunities, as investors may be reluctant to act independently against the crowd. Loss aversion refers to the tendency to prefer avoiding losses over acquiring equivalent gains. This bias can lead investors to hold on to losing investments longer than is rational, hoping to recoup their losses, rather than cutting their losses and reallocating capital to more promising opportunities. Loss aversion can also result in a reluctance to take on new investments perceived as risky, even when the potential rewards justify the risks. The influence of behavioral finance. Behavioral finance is a field of study that combines psychological theory with conventional economics to explain why people make irrational financial decisions. Understanding the principles of behavioral finance can help investors recognize and mitigate the impact of psychological biases on their investment decisions. Prospect theory, developed by Daniel Kahneman and Amos Tversky, is a cornerstone of behavioral finance. It describes how people value potential losses and gains differently, leading to irrational decision-making. According to prospect theory, investors are more sensitive to losses than to gains, and they tend to evaluate potential outcomes relative to a reference point, often leading to risk-averse or risk-seeking behavior depending on the context. Mental accounting refers to the tendency to categorize and treat money differently based on its source or intended use. For example, investors might treat a tax refund differently from their regular income, leading to different spending or investment behaviors. In the context of investing, mental accounting can result in irrational asset allocation, such as treating dividends or capital gains differently from other investment returns. Behavioral portfolio theory, BPT, suggests that investors construct their portfolios not to maximize expected utility, as traditional portfolio theory would suggest, but to achieve specific psychological goals. These goals might include avoiding regret, achieving aspirations, or maintaining a sense of security. BPT helps explain why investors might hold seemingly irrational portfolios that include both very safe and very risky assets. Strategies to improve investment decision-making. Recognizing the influence of psychology on investment decisions is the first step toward improving decision-making processes. Here are some strategies to help mitigate the impact of psychological biases and make more rational investment decisions. Diversification is a fundamental strategy to manage risk and reduce the impact of individual investment biases. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce the impact of any single investment's poor performance on their overall portfolio. Diversification helps counteract overconfidence and reduces the potential impact of anchoring bias on specific investments. Setting clear investment goals. Well-defined investment goals can help guide decision-making and reduce the influence of emotions and cognitive biases. Whether the goal is saving for retirement, purchasing a home, or funding education, a clear objective provides a framework for making investment choices aligned with one's long-term financial plan. Clear goals also help counteract the impact of short-term market fluctuations and emotional reactions. Developing a written investment plan. A written investment plan outlines an investor's objectives, risk tolerance, asset allocation strategy, and criteria for buying and selling investments. By documenting these factors, investors can create a disciplined approach to investing that helps reduce the impact of emotions and cognitive biases. A written plan also provides a reference point for evaluating investment decisions and maintaining a long-term perspective. Regular portfolio reviews and rebalancing are essential for maintaining a diversified and well-structured investment strategy. Rebalancing involves adjusting the portfolio's asset allocation to align with the investor's goals and risk tolerance, ensuring that no single investment or asset class becomes disproportionately large. Regular reviews help identify potential biases and ensure that the portfolio remains aligned with the investor's long-term objectives. Seeking professional advice. Working with a financial advisor or investment professional can provide valuable insights and help mitigate the impact of psychological biases on investment decisions. A professional advisor can offer objective analysis, help develop a comprehensive investment plan, and provide guidance during periods of market volatility. Seeking professional advice can also provide accountability and support for maintaining a disciplined investment approach. Mindfulness and emotional awareness can help investors recognize and manage the impact of emotions on their decision-making processes. By developing an awareness of their emotional responses to market events, investors can better control impulsive reactions and make more rational decisions. Techniques such as meditation, journaling, and stress management can help improve emotional regulation and enhance decision-making. The psychology of investment decisions is a complex and multifaceted subject that significantly impacts financial markets and individual investment outcomes. Ultimately, by acknowledging and addressing the psychological aspects of investing, investors can make more rational and informed decisions, leading to better financial outcomes and greater peace of mind. This is Finance Spotlight, brought to you by ThinkSpace Media. If you found this video insightful and are eager to learn more about achieving financial milestones, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments section below. Together, let's start on a journey towards financial success.